Welcome to the latest Eversheds Sutherland Legal Insights podcast.
Hello, I'm Matthew Allen, Global Head of Financial Services at Eversheds Sutherland. Welcome to the latest in a series of podcasts exploring trends and opportunities in global financial markets in 2025. In this series, we have heard from our clients and industry observers on a range of hot topics, from new technology to private credit to regulatory fragmentation and much, much more. In this latest edition, we'll be looking at trends, opportunities, and risks in ESG. To help us do this, I'm delighted to be joined by David Kaleda, one of our ERISA and fiduciary compliance experts from our Washington, D.C. office. David, welcome. It's great to have you with us today. Maybe you could start by telling the listeners a little bit about yourself, about your practice, about your background.
Sure. Thanks for the introduction, Matthew. It's Dave Kaleda. I've been practicing in the ERISA space since 1996 in a variety of different capacities, including at two large law firms, a boutique law firm, and at the Vanguard Group, which is a large institutional money manager here in the U.S. So I've been focusing on ERISA a lot, particularly from the perspective of asset managers, plan service providers, et cetera, but also plan sponsors as well.
And just for the benefit of our international listeners, just give them 30 seconds on what ERISA is.
Sure. So the ERISA is the Employee Retirement Income Security Act, which was passed in 1974 here in the United States, and it governs private sector pension plans and the management of those plans. And part of that statute is basically you have to comply with certain fiduciary duties and not violate certain prohibited transaction or conflict of interest provisions. So it's a highly regulated area by the Department of Labor, or DOL as we call it here. And there's also lawsuits that can be brought under ERISA if you violate these provisions. So it's key to the employee benefit space in the United States.
Super, thanks. Well, let's get into this. The whole sustainability agenda, ESG, particularly in the United States, become a little bit of a fraught subject. You've been advising on ERISA fiduciary matters for many, many years. How do you see that conversation around ESG changing for benefit plan sponsors and asset managers more recently?
Yeah, well, it's a political issue, but I will say environmental, social, and governance issues have always been a political issue, at least since the early 90s here in the United States, in how to consider those under the structure of ERISA's fiduciary duties. So in essence, in the early 90s, we've been seeing this whenever a new party comes into control of the White House or the executive branch here, so a new president with a new party, they'll basically change how they view or how you can consider ESG under ERISA governed plans. Democrats tend to be more favorable to considering those factors, while Republicans tend to be less so. However, what I will say in the last few years, it has become incredibly politicized to the point of the rhetoric is much stronger around it. Folks that are very anti-ESG have been very vocal ever since in about the last 5 years, so much so that we've even seen anti-ESG constituents bring lawsuits both against the Department of Labor, challenging its current, which would have been a Biden-era ESG regulation, as well as even suing a very large plan sponsor for a breach of its fiduciary duties, for allowing funds in the plan that include ESG. So that's unprecedented, this idea of being sued under ERISA in connection with ESG principles. I would say at the core, maybe not everybody would agree with me, but I think both sides understand the fundamental fiduciary issues are that you have to act prudently in the best interests of the participants and beneficiaries and strictly in their interests. So those are the duty of prudence and the duty of loyalty. And in so doing, you cannot sacrifice investment performance or assume unnecessary risk to accomplish investment objectives considering ESG. I don't think anybody would disagree with that. However, I think both sides they'll use different language around how to interpret those provisions so that one arguably is a little more favorable to ESG than others. In other words, how you can make your ESG case. But right now we're in an era where, even use of the terminology ESG evokes a very emotional response with some folks, and not in a good way, meaning it's a bad thing, which is unfortunate because I think there are legitimate ESG considerations that managers, in fact, should take into consideration.
So I want to come back to the responsibilities of fiduciaries in a moment, but you're talking about the role of the Department of Labour. That has set a framework of rules around ESG, as I understand it, and those are now being revisited as part of this shift. Just can you tell us a little bit about, what we can expect to see, and then how fiduciaries should be preparing for that evolving environment?
Right. So, certainly the ESG regulation that President Biden and his administration issued early in his administration will be revoked, and it'll be replaced with another regulation that, I expect will look a lot like the regulation the Trump administration put into place during his first term. And, that regulation will very much emphasize the term pecuniary interests. And what they're really trying to emphasize here is you can't sacrifice investment performance. You can't assume undue costs or undue risk. And they're going to use a lot of language around you really have to make a decision based on economics. And all these other things are not necessarily economical or based on the economics, unless you can prove it. And they're going to probably demand that both the plan sponsors prove it and the managers that they're hiring prove it as well, that there is a tie between these environmental, social, or governance type considerations to the economics of the investment. That's how I foresee that. And so it's going to look I expect a lot like the one we saw 6 years ago now, before it was revoked by the Biden administration. But my guess is the language might be a bit stronger.
So fiduciaries in the, this sort of feels like a cleft stick, right? In terms of, potentially not meeting these objectives, potentially setting these objectives, and that falling foul of political considerations, the different investment requirements or appetite of plan participants. I mean, how do you go about juggling? You talked a little bit about first principles earlier, but how do fiduciaries go about juggling these, often competing interests?
The word that comes to mind is carefully. And I say that tongue in cheek, obviously. But I think what I mean when I say that is you really, as a fiduciary, say you're the plan sponsor fiduciary who makes the decisions to make one or more investments available under a plan or apply certain investment strategies. I think there's going to be a lot of pressure to, again, emphasize or make the connection between the economics of the investment and how these factors factor into the economics. And you will be forced to you'll be pushed to really make that connection. And I think that's the big issue for plan sponsors. I think managers are going to have to consider moving away from not necessarily consideration of ESG factors, but the emphasis of it, of those factors. So in other words, or maybe the way to put it is they have to, when they describe it, whether it's in an offering document or a marketing materials, describe how they're using, how environmental factors factor into the investment. So for example, here's an example. One of my clients at my former firm, they invested in a farmland fund. So the fund directly invests in farmland in the United States. They made investment decisions. For instance, one of their big investments was in wineries, right? So basically places that grow grapes. In our country, that area of the world that or area of the country that does very well in that area is Northern California, right? So, but there are other regions as well that grow grapes. But I would say, arguably, economically, that is the most productive area in the United States. However, the fund has to consider the fact that Northern California has a lot of fire risk, like forest fire risk, that wipes out these fields. And so even though those produce a lot of grapes, just from a diversification standpoint, they have to consider the Pacific Northwest or upstate New York, some other growing areas. Now, whether you think that's because the fires are caused by climate change or something else, the reality is the data bears out they do have a high fire risk. So you have to consider that factor into your investment decision. I don't think either side would disagree that that's a legitimate consideration. But I think, or another example would be that same, or a real estate fund, not investing in a lot of waterfront property in a state like Florida, which is very hurricane prone and you can't get insurance. So yeah, you will invest in Florida, but you're also going to invest in a lot of other markets as well. Again, whether you think that's driven by climate change or not, the fact is they do have a lot of hurricanes and flooding issues. So it's not a smart investment to put all your eggs in that basket. So I think, I think unfortunately what we're seeing is, because if you use this term ESG, it's like this bad word, then the decisions I just described are somehow wrong, when clearly they're linked to the economics of the investment. So, I think what managers have to consider is, how they describe that investment process and not emphasize the term ESG so much.
So it's almost like a reframe, not necessarily a changing of the investment portfolio, as much as a reframing of, so there's a clear understanding of, the reasons behind it. So just trying to sort of pull all that together, David, incredibly helpful and thoughtful. So to the extent anyone can look ahead, as far ahead as 5 years, you sort of think, 5 months is a long time these days in politics and in the regulatory landscape. But looking ahead over the next sort of 3 to 5 years, what do you see as the biggest challenges and opportunities for plan sponsors?
Yeah, so certainly the ESG is going to be out of favor. One interesting nuance to ESG, though, and I think and this might be for for our UK audience or others outside the United States, like obviously you want to attract capital from the US, and a big source of capital can be ERISA covered plans. There are also another source is governmental plans. Governmental plans, so in other words, retirement plans or medical plans offered to government employees, those are not subject to ERISA. They're subject to state laws. Some of those state laws look a lot like ERISA, but some don't. So those are two sources of capital. So you might want to think about who you're talking to and when you market to them, because if you have and it's very common. I look at a lot of UK oriented funds or non-US oriented funds, and there is a lot of emphasis on what one might call ESG like principles, because in Europe that's a good thing. Like that's favorable to do that. That hasn't really, but again, that's not the situation here. So what you might want to do is consider how you kind of describe the fund to that market, and note that a governmental plan, like if you were marketing to a plan in California, they'd be very happy to see ESG like stuff. On the other hand, if you were doing the same thing in Florida, probably not so much. So you have to think about that as well. But I don't, notwithstanding maybe some limitations or scrutiny around ESG investing, I don't think it's all bad here. I think what we're going to see and maybe some good news for both plan sponsors and asset managers, is this allowance of more creativity in the investment process, particularly for defined contribution plans like 401k plans, where those plans will make available access to asset categories that maybe are viewed as hard to offer under ERISA covered plans, like alternative assets. I think lifetime income products, we do a lot of work here, and that's been a huge area of interest to protect the lifetime income stream of participants, even in the defined contribution plan markets, because we don't really have many pension plans these days here. There could also be, we've certainly heard some noise on the Hill that there is consideration of a litigation reform around ERISA, because that is one of the threat of litigation does, particularly in the plan sponsor market, make them, plan sponsors, reluctant to do new things because they're afraid of getting sued. So in order to change that, that will require congressional action. And there's certainly some bills out there suggesting that that could come into play. I mean, the reality is getting anything done in our Congress can be, which is our legislative branch, can be very difficult, if not impossible. And this would be a pretty huge lift to occur. But if it did, that could allow for opening the doors to some of these more creative type of investment strategies and all. But that remains to be seen. So I think, ESG probably out of favor, but as soon as the Democrats come back in, which will happen sooner or later, you will see somewhat of a shift back. The question is how much of a shift, and that makes things hard, as you've kind of alluded to. It's just, how do we do compliance when it changes every 4 to 8 years, or 12, whatever it turns out to be? And that's a fair point, particularly in the ESG space.
David, thank you very much indeed. We could chat all day, I'm sure, but we'll have to draw a close there. Thanks for joining us today and for your really helpful insights. And of course, thanks to you, the listeners, as always, for joining us. If you'd like to know more about any of the issues we've been discussing today, I'm sure David would be delighted to hear from you. So please don't hesitate to get in touch. We hope you find these Insight series of financial services podcasts thought-provoking and helpful. And we look forward to more reflections and thoughts from our partners and clients in the year ahead. Thank you.
Thank you for listening to the Eversheds Sutherland Legal Insights podcast.